Imagine a man who danced across stages worldwide, traveling from city to city, barely sleeping, always performing. Yet, in the 1950s, he became one of the most unlikely winners on Wall Street. Nicholas Darvas didn't have a finance degree, insider tips, or a trading floor shouting in his ear. He had one thing: a system born from patience, observation, and relentless discipline. Every night, after the applause faded and the theater lights dimmed, he studied stock charts with the same precision he practiced his routines. While amateurs relied on rumor, speculation, or sheer luck, Darvas built a method that transformed uncertainty into opportunity. Most amateurs see trading as a shortcut to wealth. They chase rumors, tips, and the next hot stock. Professionals see it differently. They respect risk, understand position sizing, and wait for confirmation. Darvas understood this better than anyone. He transformed fear into a signal and greed into a disciplined tool, turning emotions into strategic information rather than destructive impulses. Here's the brutal truth: the market doesn't care about your dreams. It only cares about probabilities, tape patterns, and emotional control. Amateur traders lose because they trade impulsively, increasing position size too fast, or ignoring stop losses. Professionals, like Darvas, act only when the setup is right. And the setup isn't just technical, it's psychological. The real edge is not the chart, it's mastering your mind while the tape reveals the story. Imagine watching a stock bounce between $50 and $55 for days. The amateur frets, wondering if he is missing an opportunity. The professional observes, records, and waits. The price range, or box, becomes a silent teacher. It defines the limits of risk and signals potential for profit, but only if patience guides your action. Darvas's secret wasn't flashy technical indicators or sophisticated software. It was something much simpler, something most amateurs overlook. He created boxes around price ranges, waited for pivotal breakouts, and let profits accumulate while cutting losses fast. Patience wasn't passive, it was active. Each trade required attention, discipline, and adherence to clearly defined rules. He didn't just trade stocks. He traded his emotions. One small misstep, a premature entry or a stop-loss ignored, could undo weeks of careful observation. But when he followed the system, every decision had a clear risk-reward structure. Think about this. What if waiting was your strongest weapon? What if doing nothing sometimes made you more money than frantic trading? Darvas showed that markets reward those who can resist the urge to act without confirmation. Amateur traders are enslaved by impulses. Professionals cultivate patience as a superpower. And it's not just about money, it's about clarity. Each box he drew clarified where to enter, where to exit, and where to stand aside. Fear becomes a signal, not a stop sign. Greed becomes a tool, not a trap. In this story, we'll uncover each principle he used, step by step. You'll witness how a traveling dancer, without a Wall Street pedigree, beat professional traders at their own game. By the end, you'll understand why amateurs fail, why professionals succeed, and how discipline, patience, and a simple box system can consistently turn risk into reward. And the first clue is already in front of you: the market rewards those who sit quietly, observe the tape, and only act when a pivotal point confirms itself. But how exactly did Darvas turn boxes into a fortune? That's what we explore next, where the amateur mindset breaks, and professional psychology begins, revealing secrets most traders never notice. Darvas's first rule sounds almost too simple: draw a box around a stock's recent high and low. Most amateurs see charts as chaos, filled with meaningless squiggles, reacting impulsively to every spike and dip. Professionals see patterns, ranges, and pivotal points. A box isn't just a rectangle on a chart, it's a measure of market consensus. It communicates the invisible conversation between buyers and sellers. By defining this range, you can measure risk, calculate position size, and identify the precise moment the market shifts from indecision to conviction. One story illustrates this perfectly. Darvas noticed a stock bouncing between $50 and $55. Instead of buying immediately, he let it trade inside the box for weeks. He treated it like a performance on stage, observing every movement, every nuance, every hint of volume change. Each day, he studied the tape, noting which price levels held and where the buying or selling pressure concentrated. When the breakout occurred above $55, with strong volume confirming the move, he acted decisively. His position size was calculated to limit risk, and the stop-loss was placed just below the box. In that moment, he didn't feel fear or greed, he felt control. He had waited for confirmation, and that waiting was his edge. The takeaway is simple yet powerful: patience creates opportunity. Don't guess. Don't hope. Wait for the stock to signal its intentions. Box trading enforces discipline, preventing premature entries driven by fear of missing out or greed for quick gains. It's paradoxical: the less you force action, the more you capture profit. Many amateurs believe constant activity equals success. Professionals know the opposite: doing nothing, observing the tape, and letting the market reveal itself is far more profitable. A maxim Darvas lived by was, "A box defines risk and reveals opportunity." Every box tells a story: where to enter, where to exit, and how to respond when the tape signals change. Another protocol: never pyramid inside a box. Amateur traders often layer positions recklessly, chasing sure wins. Darvas only added after a confirmed breakout. The market punishes impatience with sudden reversals, failed breakouts, or sharp losses. He understood that compounding risk inside uncertainty destroys accounts faster than missing a single trade. This principle also reveals the psychological divide between amateurs and professionals. Amateurs see the breakout as an event to seize immediately, letting emotion drive them. Professionals see it as confirmation to act strategically, with rules guiding every step. By waiting, professionals leverage the tape to eliminate guesswork. Fear warns them, but it doesn't dictate action. Greed tempts them, but position size and stop losses contain it. Notice how this sets the stage for later rules. The next step isn't the breakout itself, it's how you manage the position once it begins to move. This is where many amateurs falter. They enter a trade, watch profits appear, then act impulsively, abandoning rules under emotional pressure. Darvas, however, had already accounted for human nature, creating a system that blends psychology with technical precision. And here's the cliffhanger: waiting for a box breakout is easy to understand in theory, but hard to execute in practice. Fear screams to enter early. Greed whispers to buy too much. How did Darvas overcome these impulses? The answer lies in his meticulous discipline with position sizing and stop losses, a secret we will uncover in the next chapter, revealing how a professional protects capital while letting opportunity unfold. One of the most brutal lessons every trader learns is that losses are inevitable. No matter how skilled or disciplined, the market will always test your rules, patience, and emotions. Most amateurs treat stop losses like polite suggestions, hoping the stock will reverse in their favor. Professionals, however, treat them like commandments, non-negotiable rules that protect capital and preserve opportunity. Nicholas Darvas mastered this principle, turning it into a cornerstone of his success. He understood that capital preservation is not just a guideline, it is survival. Without protecting the downside, even the best setups will eventually destroy an account. In one memorable instance, Darvas bought a stock immediately after a breakout. Within hours, the price dropped by 3%. Many traders, gripped by panic and fear of missing the move, would have held or even added to their position. Darvas did neither. His stop loss was triggered, and he exited calmly, accepting a measured contained loss. Later, the same stock surged dramatically, but by following his protocol, he had preserved capital for future opportunities. This small, disciplined loss enabled him to stay in the game, while amateurs chasing hope often blow their accounts on a single impulsive trade. This exemplifies the essence of professional trading: size small, manage risk, and remain emotion neutral. Fear is not the enemy, it is a guidepost, signaling potential danger or pivotal decision points. Greed is not evil, it is a test of discipline, measuring whether you can follow rules rather than impulses. Every position must have a defined risk. Every trade should honor the tape, respect pivotal points, and obey your predefined entry and exit criteria. Position size must align with total capital, so no single trade can destroy your plan. Profit targets are important, but flexibility is essential when the tape confirms momentum. Pyramiding, adding to winning positions, works only after confirmation, never based on hope or wishful thinking. Darvas encapsulated this philosophy in a maxim: cut losses fast, let winners run, patience compounds profits. It is deceptively simple but psychologically profound. Many amateurs feel bravery in holding onto a losing trade, believing endurance equals courage. Professionals know the paradox: True courage is following your rules calmly, regardless of emotion, and letting the market teach you without interference. The act of cutting a loss is not surrender, it is disciplined foresight. It signals intelligence, not failure. The interplay between fear, tape reading, and position management distinguishes the amateur from the professional. Darvas didn't simply cut losses quickly, he allowed fear to inform decisions without dictating them. He observed price action and volume, not news headlines or speculation, waiting for confirmation before committing further. He transformed what terrifies amateurs into actionable signals. By treating fear as data and greed as discipline testing, he maintained both psychological balance and strategic advantage. And here's the teaser for the next chapter. Darvas's ability to cut losses fast was only part of the puzzle. He also harnessed fear and tape patterns to build conviction in his winning positions. Unlike amateurs, he reacted to confirmation, not noise. Understanding this subtle difference, how to convert emotion into a measurable edge, separates the professional trader from the impulsive amateur. In the next chapter, we'll explore exactly how he turned fear into a signal and leveraged it for consistent profits, completing a critical component of his trading psychology. Amateurs see fear and exit. Professionals see fear and measure it. Nicholas Darvas treated fear like a compass, not a brake, using it to identify pivotal points rather than as a reason to retreat. Fear is often misunderstood. It is not a signal to sell, but a guidepost showing where the market's decisions are most critical. A stock may linger just below a breakout, testing previous highs, teasing both buyers and sellers. The tape oscillates, volume spikes, and emotions ripple through the market. Most amateurs panic, abandoning positions too early, convinced the move will fail. Darvas, however, watched patiently, reading the tape as if it were a story unfolding. Every small fluctuation held information. When fear reached its peak, when the market hesitated and indecision climaxed, he knew a pivotal point was forming. That's when he acted decisively, not impulsively. The protocol is precise. Chart volume spikes, observe tape reactions, and let fear signal opportunity rather than dictate action. Always use stop losses to contain risk, and add to positions only when confirmation occurs, never on anticipation or hope. This is where discipline separates professionals from amateurs. The amateur is reactive, the professional is deliberate. Fear becomes a measured input, a signal to focus attention and confirm setup integrity. Darvas turned psychological tension into a strategic advantage. Mini-maxim, fear defines the edge, patience realizes it. Acting without confirmation transforms fear from a guide into a liability, but when managed correctly, it pinpoints exactly where to enter and where to measure risk. Pyramiding, another cornerstone of Darvas's method, illustrates this principle. After a breakout, when fear begins to dissipate and the tape confirms upward momentum, he increased his position size incrementally. Many amateurs pyramid too early, letting emotion drive them into excessive risk, often right before reversals wipe out gains. Professionals, in contrast, pyramid only after validation. Each addition is calculated, with stop losses adjusted but never ignored. This disciplined layering ensures profits compound while exposure remains controlled. Understanding when to act and when to wait is the ultimate psychological advantage, and Darvas mastered it by integrating observation, risk management, and emotional control into every trade. Notice how chapters 2 through 4 interlock seamlessly. Boxes define opportunity and reveal price ranges worth attention. Stop losses protect capital and enforce discipline. Fear signals execution points, transforming psychological pressure into actionable insight. Darvas's genius was nesting these rules within both technical and mental frameworks. He didn't just follow charts, he managed his mind. He knew that a well-placed trade without emotional mastery is vulnerable to chaos. By controlling his reactions, he converted uncertainty into measurable edges. Each rule reinforced the other, creating a resilient system that worked under the harshest market conditions. And here lies the cliffhanger. If fear can be a signal, how do you consistently read it without letting greed or overconfidence destroy your discipline? How do you know when hesitation is caution versus hesitation being an error? These subtle distinctions determine whether an amateur flounders or a professional thrives. The answer to this, and the full integration of Darvas's mindset, will be revealed in the final chapter, where the complete framework comes together. It's here that boxes, stop losses, fear signals, and pyramiding coalesce into a coherent, repeatable process, demonstrating how a disciplined mind converts risk into lasting opportunity. Everything converges here: patience, boxes, stop-losses, tape reading, and fear management. Nicholas Darvas's edge wasn't magic, it was process. Amateurs chase randomness, reacting impulsively to every price swing, every rumor, every headline. Professionals, however, own the process. They understand that the market doesn't reward emotion, it rewards discipline executed consistently. Every rule Darvas developed, boxes, breakouts, stop-losses, position sizing, pyramiding, was part of a single integrated framework designed to turn uncertainty into measurable advantage. The system begins with identifying boxes. These are not arbitrary rectangles. They define the market's current consensus, highlighting pivotal points where buyers and sellers battle for control. Professionals wait for the breakout of these boxes, using it as confirmation rather than acting on hope. Stop losses are then set with precision, aligning risk with account size. Position sizing follows strict calculation, ensuring that no single trade threatens survival. When the breakout confirms and momentum builds, winners are allowed to run, and additional positions are added only after validation. This combination of rules forms the backbone of professional trading, transforming fear and uncertainty into a disciplined, repeatable method. Psychological mastery is equally critical. Darvas observed fear rather than reacting to it, letting it guide his attention to pivotal moments. Greed was treated as a test, not a temptation. Emotions were never allowed to dictate action. They were recorded, measured, and neutralized by rules. Many stories from his career illustrate this clearly. He missed breakouts that seemed obvious to others, yet tiny losses preserved capital for future opportunities. He cut positions decisively when stop losses triggered. He pyramided strategically, increasing positions only after confirmation, never on impulse. Each step reinforced the other, creating a self-sustaining cycle of disciplined growth. Maxims to internalize from Darvas's approach include: do nothing until confirmation. Patience is profit. Risk is survival. These are not platitudes. They are practical rules for surviving and thriving in a market designed to punish indecision and impatience. The nested loops of his strategy now close. The boxes from Chapter 2 provided clarity, the stop-loss discipline from Chapter 3 protected capital, and fear as a signal from Chapter 4 guided execution. Professionals follow these rules consistently. Amateurs chase hope, expecting luck to fill the gaps that discipline should cover. The actionable close is simple but powerful: cut losses fast, size small, wait, own the process. Each principle reinforces the others. Following this framework doesn't just manage risk, it compounds advantage. It turns the market's uncertainty into predictable opportunity. This is the mental and technical foundation that allowed a traveling dancer to amass fortunes while professionals scoffed. Discipline, patience, and observation became his greatest assets, far more than any insider tip or sophisticated indicator. And there is a soft bridge to the next step of mastery. If you have learned how discipline turns fear into opportunity, the next lesson on advanced tape reading secrets will deepen this understanding. Darvas's method is more than rules on a chart. It is a mindset, a way of interacting with a market that leverages both technical structure and psychological control. By integrating these elements, you can consistently identify pivotal points, act decisively, and protect yourself from emotional errors, turning risk into measurable advantage.